the Expert AI Crypto Perpetual Futures Trading. In this video, we're going to talk about leverage, margin, and cost. So first of all, I'm going to go through some basics. It may look a lot complicated, but then we're going to go through some simple examples and all will become clear. Try to get this as simple as possible. So when we are trading crypto futures, we need to calculate how much money or margin you need to open and maintain a position. Here's how it works. So there's some key terms we need to understand first. The position size, that's the total value of the trade you want to control. Leverage, this is the multiplier that allows you to control larger positions with less money. The initial margin, which is the amount of money you need to open the trade, there's a simple formula for this: position size divided by leverage. Don't worry, all platforms use a similar tool and it works that out for you, but I just wanted to go through the basics. And then we have the maintenance margin, the minimum amount of money you need to keep the trade open. So if your balance falls below this, your position may be liquidated. So example one, this is a low level, low leverage trade. Position size of $1,000, leverage 2x. So that's 2 times your margin. So if your initial margin is $1,000, divide that by 2, $500 is what you need. So this means you need $500 in your account to open a $1,000 position. This next example is a higher leverage trade. So position size this time is $10,000, but with a leverage of 10x, so that's 10 times your margin. Initial margin of 10,000 divided by 10 is $1,000. So here you only need $1,000 to control a $10,000 position. However, higher leverage increases your risk of liquidation if the market moves against you. And we're going to look at an example of that in a little while. So maintenance margin, this is usually a small percentage of the position size, so 0.5 or 1%. So example, if the maintenance margin is 0.5% of a $10,000 position, you need at least $50 in your account to keep the trade open. The cost of the trade includes the initial margin, the collateral you put up, and then the trading fees. So these are charged by the exchange. 0.1% is sort of normal. So for a $10,000 position with a 0.1% fee, the trading fee is $10. And this is how the exchanges and brokers make their money. They make your money by charging you a small fee every time you go into a trade to use their platform. So profit and loss impact. So your profit or loss is calculated based on the position size, not the margin. This is why leverage can amplify both gains and losses. So for example, if you open a $10,000 position with a 10x leverage and the price increases by 5%, your profit is at $10,000 times 5%, which is $500. So even though you only put up $1,000 as margin, you'll be returned that $1,000 minus the $10 to get in, and then you'll earn $500. So that's a 50% return on your margin. So keeping risk sensible with the Expert AI app is important. So with crypto trades, our algorithm calculates the risk for each individual position and suggests a maximum leverage. This calculation includes the stop loss position. So in this situation on SUI USD, we can see there is a 26x and is an indication to traders they should not go above this leverage figure. So it is also using algorithm to suggest the stop price of 3.25200. Now, any leverage below 26x is what traders should be looking for. And if your risk appetite is no more than 10x, then stick to those rules. The algorithm simply suggests a sensible maximum. So now we're going to look at basically a standard part of the trading platform. No matter which broker you're using, it will look very, very similar to this because they all use a white label solution and they pretty much look exactly the same as this. So in this situation, this is our leverage here with 10x. Okay, the next box is the available money that you've got in your account. So this is your account balance. In this case, it's 1,390 plus change USDC. This is the underlying price of Bitcoin right now, okay, of 190,917.5. So this is the cost of the trade, and we're going to go into that in more detail in a minute. And then we have the maximum available for longs, and then a maximum available for shorts. You'll notice this is slightly less than that available account here because there is going to be there's going to be fees, so they want to make sure you can cover those as well. So let's have a bigger look at this cost and go through each individual portion of it. So first of all, the position size is calculated from the leverage you have chosen. So in this case, 0.0570 Bitcoin, or 6,835 and change USDC. So even though your account balance is only 1,390, your position size, because of the 10x leverage, is 6,835. So the cost is calculated at 50% of the maximum available for longs and shorts respectively. So remember, this is a sliding scale. You can choose 10%, 20%, 100%. You know, this is a sliding scale, and this is a good example at 50%. So at this point, we have $694.48, which is 50% of this maximum available. So once this trade is in, this amount will not be available for other trades, as it will be held by the broker as margin cost for the duration of the trade. Then it will be returned when the trade is closed, unless you are liquidated. Depending on the broker, this will include maintenance costs. So more on this in the next video where we look at real world trades. So the next is the estimated liquidation price. This is an approximate price because there's always slippage with a broker if things move really quickly. And this is an approximate price where your account will be liquidated if the trade goes against you. So the current price here is nearly $120,000. And what we're saying is, because of the leverage you've used, if the price goes against you on a long and it comes down instead of up, and we get to this particular price of 96,045, that's when your account will be liquidated. If you're going short, so you're expecting the Bitcoin price to go down, but it goes up instead, 143,584 is the price in which your account will be liquidated. This shouldn't be an issue if you put the stops on that are suggested by our algorithm, because that takes into account that risk and puts those sensible stops on there to ensure that you are way in front of that liquidation price. So let's look at a different example this time. This time it's 50x. There's 50 times your margin. So that leverage is quite high, and we want to discuss the important differences that traders should be aware of. So again, same account balance, same price on Bitcoin. We have the cost again, and we're going to talk about that in a little more detail now. So we're still at 50% cost. So again, we'll be blocking 50% of the account balance. The position size has changed though because of the leverage. So this position size, 0.2786, is equivalent to $33,409, even though your account is 1,390. So we've increased the position size, but the cost is the same. Okay, we've still chosen 50% of that maximum available at that point. Okay, the big differences here are with the liquidation price. So with the increase in leverage, we see the estimated liquidation price has changed considerably. So for example, in the previous example, if you were going long on this position, and the liquidation price was 96,045. So if it went against you and kept going down, you didn't have a stop, you would be liquidated at 96,045. But now with more leverage, if your trade goes against you and you hit 115,531, which is a lot closer to the current price, your account will be liquidated. So this is where the importance of those stop losses are that we encourage you to take note of, that the algorithm suggests on the app. So let's just talk about isolated or cross leverage. There's differences here. In all those examples I just gave you, we use cross margin, which was a higher risk, but there is an option for isolated margin, which is lower risk. Only the margin allocated to a specific trade is at risk. So if we've got $1,000 account and we risk 50% on that margin, $500, that on the isolated margin type of trade, it is only that margin, that $500, that is at risk. The cross margin is higher risk because it uses your full account balance to keep a trade alive. And so if your full account, your full account balance is at risk with this particular type of margin. So again, it looks like this on a platform, cross 50x. And here we see isolated 10x and 10x, green and red. It's for longs and shorts. So in this particular situation with isolated leverage, you can choose, for example, 10x for longs and 15x for shorts, or 10x and 10x. So you've got that ability to change the leverage depending on whether it's long or short. Again, we're going to go through examples of that on the next series of videos with real examples of real trades. So that's it for now. This has been the basic trading for crypto perpetual futures for leverage, margin and cost. Look out for the next series of videos where we talk about more and use examples of real trades.